sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week is Chris. It's been quite a week already, hasn't it?
Rough week.
What's good is it's dropping in the morning, raising in the afternoon, and we were actually green this afternoon, or this morning whenever we started off. So those are all good signs. So hopefully this is an optimistic but realistic view of what's going on in the market. And I think what everyone's question really is going to be is, have we bottomed? Have we seen the bottom of this? And I'll just go right into S&P 500. If we look at our technicals here and just really look at the charts, we can see that the S&P 500 has broken the 200-day moving average. We've been talking about a correction, anticipated a correction. I would say this is earlier than we expected, but correction is definitely here. We hit that Monday morning, early, what was it, about 10 o'clock, 11 o'clock, whenever we were down as low as we are. That means next support is at 4,300. So let's kind of go through.
Yeah, I was just going to say, the technicals don't look good on this. And you have a handful of market participants that trade purely on technicals. They're not long-term investors. Those are sell signals for them. So that's a lot of what we're seeing.
But I would also say that most of the bad news is already out there, which is actually good. Whenever you start to see a lot of the technicals deteriorating, that means you're getting close to what
generally
the bottom
contrarian indicator.
Yes,
right?
Yeah, it is a contrarian indicator. So one would be the sentiment survey. How many people are bullish versus bearish or neutral on the market? And we can see, and I'll kind of interpret it because it's probably not as obvious, that we're definitely in a bearish sentiment market. That means that all those red circles down below were bearish, and if we actually look at it, it's about a 21% indicator as in bullish. So that's a pretty bearish market. Now,
these are surveys, so they're just opinion. We'll get into some measures later that are actually action, market prices. But this is just asking bullish or bearish.
They just send out a survey and say, are you bearish, bullish,
and it may sound silly, but it is actually a pretty good indicator.
A lot of these people are the ones that are going to move the market and are going to be the big price makers. So if we look back, by the way, this sentiment hasn't been this low since 1987. So very, very low sentiment in the market. And if we look back on, well, how often whenever we get into that bearish sentiment, what does the market look like 3 months, 1 year, and further out? So if we look at the 3 months mark, 82% of the time, the market was up on average 5.69% of the time. And if we go 1 year out, that's a 19.38 average return 94% of the time. Now remember, it's 94% of the time. 6% of the time, it's probably not positive. But this would actually be one of those contrarian things where we start to see this is actually good for the market. We're kind of wringing out these prices. And then I'll let you take this one.
Yeah, what we're looking at here is relative strength, and we're mainly focusing on that top portion. And relative strength is a 14-day calculation looking back of up moves and down moves. And the general rule of thumb is those horizontal lines we have drawn at 70 and 30. Those indicate overbought, oversold. So generally once you're at that low 30s and below, you're oversold.
Yes.
And of course the market can stay oversold for a long period of time, but historically looking back, it is a good indicator for reversals.
We're in that oversold, but you can definitely see more extreme oversold positions historically. So another indicator that looks rough, but is actually a positive indicator. And then one of the last things that we want to talk about is what actually triggered the event? What caused it, and can that be reversed? And what caused it was higher interest rates, and that was caused by the Fed saying that they were going to raise rates because of inflation. And we talked about this in length on a couple of other market insight calls. And the Fed didn't actually ever raise rates. They've only talked about how they're going to raise rates aggressively. And what we can do, looking at more options, is determine how many, what's the likeliness of how many rate hikes are going to happen over the year. And we can see that there's different percentages. And I won't get into the detail, but basically a couple of weeks ago, the likeliness of more rate hikes was higher than it is now. So what's happening is as that market is selling off, interest rates that were up in anticipation of the Fed raising rates are now coming down, and now that'll help with the problem that the market was suffering from, which is rising rates, because now they're declining rates. So the very thing that started this is one of the things that's getting unwound. which can then bring that market back into an upward moving market. So then
that kind of gets into the loss reverse wealth effect as
Right.
well too, right? Because we had over $4 trillion in global asset declines year to date.
Right, you know this firsthand, right? You felt it. You're thinking about a remodel on part of the, and now you're kind of questioning it as you see market.
I don't really want to do the remodel. I'm somewhere between. So feeling some losses in the portfolio.
Well, I'm sure your wife is going to be the one that actually dictates on whether that happens or not. But no, it is a real effect. You definitely will cut back spending, which would actually slow inflation if a lot of people are making that decision. They're deciding not to remodel. They're deciding not to make new purchases. So then we'll start to see inflation get down, and it ends up being a self-fulfilling prophecy. It's called jawboning by the Fed, and we're certainly seeing that because we think today during the meeting what is likely to happen, and we haven't read the notes yet, but they're going to say something like, well, we're data dependent, and that would be a signal that it's going to be the market and where interest rates are deciding that the Fed isn't just going to raise rates to just go ahead and raise rates because they think rates should be higher. They're going to be looking at the market reaction. So a downward market is going to mean the Fed is unlikely to raise rates as aggressively, which will take some of this pricing to the downside back out of the market. So we'll see those results later today. We're actually, while we're doing this, they'll be coming out. We'll be going through those notes for the FOMC meeting. Last thing, we've talked about...
one of the most important things, right?
It is one of the most important things. We've been saying a correction is due. Once again, it's coming earlier than what we anticipated. But one of the reasons we think it wouldn't be as severe is because of the amount of money that's sitting in investable accounts, or that's sitting on the sidelines. And we can definitely see that it was very elevated. $3 trillion of money market funds is very, very high. And we can start to see that there's actually some of these, through these dips, people are looking to put that money into use. My guess is next week, whenever we look at this, it'll be much higher than $51 billion. And that reflects a late in the day market appreciation. So that relief rally that's becoming late in the day, where last week, what we would start out high and then would sell off during the evening. That was bearish. Now we're the other way, where we start off low and then people enter the market. That's a little bit more bullish. So good chance that we've seen near the bottom of this move up. One thing I am concerned about, though, is you get a relief rally. We'll get what's known as a 60% retracement. So we'll get back 60, maybe even 70% of what we've gone down from our recent high. And it'll be crucial on whether the market continues to move up from there or begins to move down, because then it could be another leg, which then we'll have to reassess this whole situation. Things that we're looking at, we continue to look at our systemic risk. We definitely have yield curve, bullish percent index, money supply, as well as consumer sentiment in our red. Housing, 4 months has been it's been slowing or declining, so I wouldn't be surprised next month to start to see that move into red. So we are putting on hedges in the portfolio to kind of watch that, and we will be paying a lot of attention. This is what it looks like in November. Money supply, if it starts to tick up, which we saw the numbers, they actually were
we got
last
those
week.
numbers yesterday.
They were looking good.
Yeah.
So we're kind of at that at a decision point coming up over the next month on whether we need to be more defensive in portfolios versus just hedged, or if it's one and done on this correction. Anything else that we should cover?
No.
All right. Well, we thank you for joining us, and we hope you enjoyed it. Please hit that like button if you did. Make sure to share this with others if they're concerned about this market sell-off. You can always call one of our lead advisors here to talk, or Chris and I will also be happy to take those phone calls. If you haven't subscribed already, please hit that subscribe button. I'll continue to work on English. I'll eventually be able to get these words out of my mouth by next week, and we hope you join us then.